Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to help investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to this special series on life goals brought to you by Money Simplified, your guide to money and mutual funds. In our first series, we covered retirement planning as life goal 1 through 6 videos. We now start with life goal 2, which is tax planning, and we would cover this across 6 videos. We are glad to have you with us for our first session on tax planning, and that is reducing tax liability by using deductions under Chapter 6A of the Income Tax Act 1961. Alright, so let's get started. All of us engage in some economic activity and earn an income to make a living. Based on the quantum of income, we, as citizens of this country, have a constitutional duty to abide by, that is, pay taxes and contribute to the nation-building efforts of the government. Nevertheless, it is equally important to save tax to the extent possible through tax planning. Remember the proverb, a penny saved is penny earned. In this session of Money Simplified, we will tell you how to reduce tax liability optimally by using deductions under Chapter 6A of the Income Tax Act 1961. So let's begin with our today's session on reducing tax liability by using deductions under Chapter 6A. Computing gross total income and net taxable income. The process of tax planning begins with computation of gross total income. Gross total income is the total income earned by an individual before availing any deductions under the Income Tax Act 1961. This includes income from various sources like salary, house property, profits and gains from business and profession, capital gains short-term and long-term, and income from other sources. This helps you to assess where you stand in terms of the total income earned during a financial year. It is vital to know your GTI or gross total income to undertake tax planning exercise prudently so that you can plan by using the relevant provisions of the Income Tax Act to avail applicable deductions to GTI. After having computed GTI, the next step is to compute a net taxable income or NTI. Net taxable income is the amount obtained after subtracting various deductions under Chapter 6A, which contains deductions under Section 80C to 80U of the Income Tax Act from GTI. So here's the snapshot of deductions available under Section 80C to 80U of the Income Tax Act 1961. 80C covers instruments such as equity-linked savings schemes, public provident fund, employees provident fund, national savings certificates, senior citizen savings schemes, fire tax saving bank fixed deposits, fire post office time deposits, premium paid for life insurance plans, housing loan repayment, etc., which offers a maximum limit of Rs 1.5 lakh as a deduction. 80CCC is contribution to pension fund of life insurance. 80CCD is contribution to pension scheme, national pension system notified by the central government. 80CCG is Rajiv Gandhi equity savings schemes. 80D is the premium paid for medical insurance. 80DD is maintenance including medical treatment of a handicapped dependent who is a person with disability. 80DDB is expenditure incurred in respect of medical treatment. And there is 80E, interest on loan taken for pursuing higher education. And there are other sections like Section 80G, 80GG, 80GGA, 80GGC, 80DTA, 80U. And availing and accounting for these deductions help you reduce your taxable income and your tax liability, which in turn can help you achieve your long-term financial goals. Now let's focus on the most popular section, Section 80C, which encourages one to invest and save tax effectively. Equity-linked savings schemes. The returns offered hereon is market-linked. The ongoing lock-in period for equity-linked savings schemes is 3 years. The minimum one can invest is from Rs 500 to no upper limit, and premature withdrawals is not permitted under equity-linked savings schemes until the lock-in period is over. Then the next is unit-linked insurance plans. Unit-linked insurance plans also offer a market-linked return. The tenure is 10 to 20 years and the lock-in period is 5 years. The premium varies from scheme to scheme, and yes, premature withdrawals are permitted, subject to certain conditions. Then the next under the market-linked instruments is the National Pension System. The returns offered here are again market-linked. The tenure is 30 to 35 years. You can invest a minimum of rupees 500 per month or rupees 6,000 per annum, and there is no upper limit, and premature withdrawals are again permitted subject to certain conditions. Under the tax planning, the assured return way, as you know, there is first the Public Provident Fund. Public Provident Fund currently offers a rate of interest of 8.7% per annum, and the tenure is 15 years. The minimum amount which one can invest is 500 with a maximum limit of rupees 1.5 lakh. Premature withdrawals are again permitted subject to certain conditions. Then there is National Savings Certificate, which offers currently a rate of interest of 8.5% per annum and has a tenure of 5 years. The minimum which one can invest is rupees 100 and there is no upper limit, and premature withdrawal is not permitted. Then there are other assured return tax saving instruments such as tax saving bank FDs, post office time deposits, senior citizen savings schemes, and non-unit link insurance plans. The Section 80C offers you a host of popular investment instruments, as we mentioned here, which are market-linked as well as fixed income investment instruments. Investing in any or all the instruments under Section 80C qualifies for a maximum deduction of rupees 1.5 lakh per annum. Let's talk about tax saving through mutual funds. Under that, first, equity linked savings scheme. Most ELSs are diversified equity funds with a lock-in period of 3 years. An individual, an HUF, is entitled to deduction from a gross total income from investments in ELSs up to rupees 1.5 lakh under Section 80C of the Income Tax Act 1961. You can invest in ELSs with as little as rupees 500 and can invest via SIP, that is the Systematic Investment Plan mode, or lump sum mode, depending upon what suits you. But every SIP installment would be subject to a lock-in period of 3 years. ELSS should not be looked upon as a 3-year product because of the lock-in, but more as a product to reach long-term goals which are generally more than 5 years away. Now let's focus on Rajiv Gandhi Equity Savings Scheme. Rajiv Gandhi Equity Savings Scheme, or RGSS, was introduced in the Finance Act 2012 under Section 80CCG, which provides for a deduction for investments in RGSS. The deduction under RGSS scheme will be available to new retail investors who comply with the conditions of the scheme and whose gross total income for the financial year in which the investment is made under RGSS is less than rupees 12 lakh. Section 80CCG defines new retail investors inter alia shall mean any resident individual who has not opened a demat account. The maximum investment permissible for claiming deduction under RGSS is rupees 50,000. Investors would get a 50% deduction of the amount invested from the taxable income for that year under Section 80CCG. The benefit is in addition to deduction available under Section 80C. Investments are to be made directly in eligible listed equity or follow-on public offers of such listed equity or into units of mutual funds and ETFs. The total lock-in period for investments in RGSS will be divided into fixed lock-in period and flexible lock-in period. The initial period of lock-in shall be known as fixed lock-in period, which shall commence from the date of purchase of the securities in relevant financial year and end on the 31st day of the March of the year immediately following the relevant financial year. The new retail investors shall not be permitted to sell, pledge, or hypothecate any eligible security during this fixed lock-in period. The period of 2 years beginning immediately after the end of the fixed lock-in period shall be called the flexible lock-in period. Upon the completion of the fixed lock-in period, new retail investors would be allowed to trade in the eligible securities. Investors would, however, be required to maintain the level of investment during the next 2 years, that is, the flexible lock-in period, at the amount for which they have claimed income tax benefit or at the value of the portfolio before initiating a sale transaction, whichever is less, for at least 270 days in each of these 2 years. Such investment value shall exclude the value of the investment which is under the fixed lock-in period. Now let's learn with the help of an example. So say you have invested a sum of rupees 1 lakh and rupees 50,000 in ELS and RGSS respectively for deduction under Chapter 60 of the Income Tax Act. You can avail rupees 1 lakh deduction under Section 80C for investments in the ELSS, while for RGSS it will be 50% of the amount invested, that is rupees 25,000 under Section 80CCG. Thus the total deduction one can avail will be rupees 1,25,000. Computing tax payable. After having effectively saved tax using Section 80C to Section 80U, compute a tax liability. Tax liability is computed based on your income tax slab. The income tax rates for individuals and HUFs for financial year 2015-16 is depicted here. For individual including NRIs and PIOs, that is person of Indian origins, and HUF, net taxable income up to rupees 2,50,000 is exempt from tax. Net taxable income between 2,50,001 and rupees 5 lakh is subject to tax at the rate of 10%, between rupees 5 lakh 1 and rupees 10 lakh at the rate of 20%, and above rupees 10 lakh at the rate of 30%. For resident senior citizens, that is 60 years and above but below 80, the basic exemption limit is rupees 3 lakh. Hence, for them, income between 3 lakh 1 to rupees 5 lakh is taxable at the rate of 10%, between rupees 5 lakh 1 to 10 lakh at the rate of 20%, and above rupees 10 lakh at the rate of 30%. For resident super senior citizens, that is those aged 80 and above, the basic exemption limit is rupees 5 lakh. Hence, income over rupees 5 lakh but up to rupees 10 lakh is taxable at the rate of 20%, while above rupees 10 lakh 1 is taxable at the rate of 30%. Also, if your total income during the financial year exceeds rupees 1 crore, an additional surcharge at the rate of 12% would be levied. This is in addition to the 3% cess that is paid on the total income tax. Apart from the tax rate, you have to pay an education cess at the rate of 2% plus a secondary and higher education cess at the rate of 1%, a total of 3% as cess on your computed tax liability. For individuals whose net taxable income is below rupees 5 lakh, a tax credit or a special rebate of rupees 2,000 is available under Section 87A. But the rebate is limited to the extent of your tax liability or rupees 2,000, whichever is less. Thus, if your tax liability is say rupees 1,500, you will get a tax credit of only rupees 1,500 under Section 87A and no tax will be payable. Let's take an example again. Assume your gross total income is rupees 11 lakh and you invest 50,000 in RGSS and 1 lakh in ELSS. The total deduction you will be eligible for under Chapter 6A will be rupees 1.25 lakh. This will reduce your net taxable income to rupees 9.75 lakh as per this table. Out of the NTI, the first rupees 2,50,000 will be exempt. The slab between 2,50,000 and 1 and rupees 5 lakh will be taxed at the rate of 10%, that is a sum of rupees 25,000. The next slab between 5 lakh 1 and rupees 10 lakh will be taxed at the rate of 20%. That is balance rupees 4,75,000 will be taxed at the rate of 20%, that is rupees 95,000. Total tax payable before education cess will amount to rupees 1,20,000, and after adding total education cess of 2% and senior and higher education cess of 1% on tax payable, the tax liability will be rupees 1,23,600. It should be noted that during the financial year, if tax has been deducted at source from your account, don't forget to adjust or account for the same while computing your tax liability and furnish the respective forms while filing your income tax returns. Here are a few quick points you should look at to reduce your tax liability. Avail exemptions and deductions available under the respective heads of income. Invest in tax saving instruments under Section 80C of the Income Tax Act to avail a maximum deduction of Rs 1.5 lakh. Optimize your tax deductions further by effectively using other deductions available under Chapter 6A, thinking beyond the provisions of Section 80C. And last but not the least, try to complement investment planning with tax planning. Consider your age, income, expenses, assets and liabilities, risk appetite, and financial goals to prudently select investment instruments in this exercise. You may seek the help of an independent financial advisor or a financial planner or a tax consultant for the same. For example, you may choose ELSs for their potential to provide higher inflation-adjusted returns over the long run, though they are relatively riskier vis-a-vis traditional tax-saving products offering assured returns. Remember, tax planning as an exercise is not just limited to filing returns and paying taxes. It is a process whereby your larger financial plan needs to be taken into consideration after accounting for a host of factors. So in the last quarter of the financial year, ensure you're taking the right steps on tax planning. So to end our learning exercise today, we now invite you to test your learning by taking up the simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.